how are these banks making money? What's going on here that's putting themselves at risk? Because obviously they're being greedy. And how should they be making money?
Well, here's the thing. Okay, so this gets into the Wyoming Special Purpose Depository Institution approach, and as Lynn Alden tweeted yesterday, the narrow bank approach as well. That is a Connecticut uninsured depository institution, very similar to the Wyoming uninsured special purpose depository institutions in the sense that they're non-lending banks. If they're not insured, they can't lend, can't take leverage. Okay, great. So they're going to sit 100% in cash, which is exactly what the business model of both was. Now, in the case of the Wyoming Speedies, they're not permitted to be what's called a narrow bank. The Wyoming Speedies cannot just literally take deposits and turn around and pay the interest on that the Fed pays the bank, turn around and pay that to their depositors. That was the narrow bank's business model. So Wyoming, by law, the special purpose depository institutions have to do something else. What is it that they have to do? They have to provide custody services for digital assets. That's how they make their money. So ding, 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 ding. Traditional banks make money off spread. These uninsured banks make money off fees. Okay. And that is how the Wyoming special purpose depository institutions work. A lot of people ask the question when it all came out, how is it that Custodia and Kraken Bank and there are two Wyoming Speedies and more on the way. How is it that they would make money? The answer is they're going to charge you fees. Okay. And a lot of folks will look at that and say, oh, I don't want to pay fees to my bank. Well, how is it that you avoid paying fees to your bank? It's because they're taking your money and turning around and taking undue risk with it. It's the same thing with Robinhood, right? And all these retail trading platforms that don't charge you fees anymore to trade your securities. Well, stop and think about that. If they're not charging you fees, how are they covering their costs? They've got capital requirements, they've got huge technology requirements, and they've got huge staffing requirements. So what are they doing with your stocks in order to be able to offer you free trading with no commission? They're taking risk, okay? And you better hope that you don't have stocks with those types of firms, because if they blow up, guess what? You're not going to get all your money back. I heard an incredible interview this morning with a biotech firm that had all their cash at Silicon Valley Bank and had to scramble over the weekend to borrow money from the board of directors and piece together because they owed payroll on Monday morning, and they would have been out of compliance with the law had they not paid payroll on Monday morning, and they were able to do it. But here's the thing. He said, it was my money. I had my money sitting in a non-interest bearing account at Silicon Valley Bank. It was the company's money. Your money in your bank account should be yours. And he's right, except that that's not the way the system works right now. And you know, yeah, go ahead.
Well, I was going to say, because we've got used to free services, but, you know, imagine a scenario where you are a company like this and you're opening up an account with someone like a Signature or Silicon Valley, and they say, listen, you've got two options. We can charge you to custody your money, and your money is 100% protected, it's 100% reserved, or
Correct.
We don't charge you, and the other option is we try and invest your money, but there's inherent risk with that. This is where we're investing your money. This is the liquidity issues we might come in. You have a choice then.
Correct.
The problem we seem to have now is, and it's something that Troy Cross tweeted out yesterday, these banks are essentially full reserve because the FDIC has backstopped the entire value.
The Fed has, really.
Well, the Fed has, sorry.
Because the FDIC only has $126 billion, I think, of funds in its insurance fund, and it can borrow another $100 billion from the U.S. Treasury. But the unrealized losses in the banking system on these long-term bonds were $650 billion, right? So now you add up, $226 billion that the FDIC has access to. That doesn't cover the entire $650 billion balance sheet hole in the aggregate U.S. banking system. So the Fed has to be the backstop. That's the punchline.
So what's the choice, though? Do we move to a system whereby it's fees for custody, or do we maintain this system whereby banks are investing money and taking risk? Because I'm going to draw out a quote. I read Lynn Alden's. I don't know if you've read a piece she put out today. I think it was this morning.
Not yet.
So her March 2023 newsletter, I look at bank solvency. I took out a specific quote. So ironically, regulators want banks to be reasonably safe, but not too safe.
Correct.
They want all banks to be leveraged bond funds to a certain degree and won't allow safer ones to exist, a la Custodia.
Yes, correct.
Why?
She's right. because that's the way the system works. And Peter, that's why the bank regulators couldn't get their arms around the concept of a bank that was literally just a money warehouse, just a bank that provided custody services for your money, but didn't turn around and lend it. Okay. And this is the same concept. We've talked about this before of a bailment. That's an old British common law concept, but we all interact with it all the time. It's the same concept as a parking garage for your car, valet parking, and it's the same concept as a coat check. It's actually the same law. We should go back to that. That's the way banking used to be. When you park your car at a valet and the valet turns around and goes and parks it in the garage, the valet doesn't have the right to take your car and let an Uber driver go make money with it while you're off having dinner. And then maybe they'll give you the same make and model back, okay? And by the way, they stick you with the risk of a problem with it. That is not how it should work. If you still legally own title to your car while it's parked at the garage and the garage goes bankrupt, you can go drive your car away. That exact same approach should apply to money. That is what the Wyoming Special Purpose Depository Institution charters are. But it was so interesting going through the Fed application process. I'm limited in what I can say, but I will say that not everyone understood this concept. Those that understood it loved it. And clearly the folks at the top who ultimately blindsided us after we were making a lot of progress. I've said this publicly before. And then they blindsided us in January with this sudden U-turn. And it was pretty clear that there was something that was A, political, coordinated by the White House, but B, so much bigger than just custodia. Our application was not allowed to stand on its own. We have due process rights. America is a country of rule of law still, and we are pursuing those.
So can we just explain a little bit for people listening what actually has happened here with Silicon Valley, specifically in relation to the zero interest rates and how they took the deposit, put them into bonds, and then with the pivot and the massive interest rates, how that completely screwed these banks?
Yeah, so they got whipsawed, right? In some ways, it's like the retail whipsaw effect that we've all seen with supply chains, right? There was a shortage of toilet paper. Then all of a sudden, the toilet paper is sitting on massive pallets in the middle of the aisles of the grocery stores because they way overproduced and there's not that much demand for it anymore, right? It's called the whipsaw effect. And that's exactly what happened to the banks because the system got over liquefied when the Fed expanded its balance sheet, aka printed all the money during COVID and kept, cut interest rates as well. So one thing that is confusing to a lot of folks, the Fed does two things to stimulate or retrench the economy. They move interest rates up and down, and they also move their balance sheet up and down. Those are two things. And by the way, they might actually not be moving in the same direction. That's where we are right now, where I suspect the Fed's going to keep raising interest rates, but they're also going to be expanding their balance sheet. So they're kind of, doing two things that have the opposite effect. But long story short, the whipsaw effect, right? You saw these huge deposits being deposited in a number of banks, including Silicon Valley, right? You had a tech bubble and you also had a crypto bubble. Those two things were disconnected, but they had the same root cause. And that caused these few banks to have a huge influx in deposits. And the banks got greedy. They should have just sat with that cash in their Fed master account, but they turned around and bought U.S. Treasuries. Now, the way bank capital requirements work is there's really not a capital penalty for the bank to go buy 10 or 30-year U.S. Treasuries or to go buy government-guaranteed mortgage-backed securities, which are, of course, long duration, because mortgages in the U.S. are typically, 15-year plus duration. Okay, so long story short, they're taking in demand deposits that could be withdrawn within the span of minutes, and they're investing in, 15-year-ish securities. It's pretty obvious that they're taking on interest rate risk and the bank capital requirements that apply to the community banks. Ironically, the big banks are immune to this because they are all in the U.S. in compliance with something called Basel III, which is the global capital standards for global systemically important banks. But the community banks in the U.S. were exempt from this. Okay, so what they did was take all this unhedged interest rate risk Now, a lot of folks, if you go back to the consensus a year ago when the Fed started raising interest rates aggressively, a lot of folks thought that this was going to be like a normal tightening cycle. Well, it wasn't. Obviously, interest rates went up faster and a lot farther than the talking heads were predicting. And so I think the banks were essentially looking at the interest rate forecasts, including the market's forward expectation of interest rates, and saying, this isn't going to be terrible. We can afford to take that interest rate risk. Well, they got whipsawed.
It seems to me there's a lot of similarities in this with what's happened here, that what happened with BlockFi and their GBTC trade. There's like a duration matching issue. I know the BlockFi GBTC trade was like a shorter term. They had to hold them to it for 6 months, but it really was the same risk profile.
Similar, yeah. You're absolutely right. There, ultimately, everything that happened in crypto lending is just the same thing that happens in TradFi, traditional finance. It's just different manifestations using different financial products, but it's the same problems. And a lot of people had to learn, unfortunately, very tough lessons. And the biggest issue, of course, is that, we're Bitcoiners, and nobody's making any more than 21 million Bitcoin. There is no lender of last resort. Ergo, anyone who leveraged it, unfortunately, had a hard lesson to learn. And there's no lender of last resort, no one to bail them out, in spite of Sam Bankman-Fried's attempts to get a Washington bailout for the crypto industry. I laughed when he called for that last fall.
Wasn't Dodd-Frank meant to prevent situations like this happening?
Yeah, absolutely. And again, that's what's so ironic. I've actually talked to Representative Frank, who was on the board, Barney Frank, who's on the board of Signature Bank. He actually, I think at the time, maybe about 7 or 8 years ago, was on the board of the World Wildlife Foundation. I don't know if he still is. Wonderful man. And we had a great conversation about Dodd-Frank, and he wanted to know, no, actually, you know what I'm thinking about it? It was actually Chris Dodd. Never mind him. But anyway, it was Dodd of Dodd-Frank. But so I don't think I've ever met Barney Frank. But I had a big, long conversation with Chris Dodd about Dodd-Frank, and he wanted to know, as somebody who was a financial practitioner, but also somebody who's interested in Bitcoin. This was probably 2015. What my thoughts were, and I laid out. Look, financial regulation should be actually pretty simple. Is the financial institution solvent? Okay, you're getting in the questions you were asking early on. You asked some really astute questions about if there's demand deposits. Why are the banks turning around and basically, to use the analogy, a parking garage that when you park your car, they'll go off and rent it to an Uber driver and pocket all the money and stick you with all the risk. Okay, that's what your bank is doing with your money. It's like the old Bart Simpson episode that's a take on It's a Wonderful Life. And Bart figures out that he can't get his money back from his bank. And there's the Jimmy Stewart, it's in Joe's house. And then Bart goes and smacks Joe. It's hilarious because it just captures the moment, which is the banks are. Yeah, exactly.
It was Mo. Yeah, it was Mo from the tavern who punched Joe.
Okay, that's funny. But you get the point, right?
Yeah.
It's people don't realize that's how the system works. But if the system if bank regulations were requiring banks to hold 100% cash on their Fed master account for all their demand deposits, we would have a stable system, much more stable than we have today. Now, some would say, and this is where you were asking the question about demand deposits. There is a difference in the bank between demand deposits and time deposits. Time deposits are basically, CDs or savings accounts, where if you read the fine print, the bank can gate you. They can prevent you from withdrawing your deposits on demand. Those are not demand deposits. You have agreed to lend that money to the bank. What most people don't realize, including this biotech CEO who had 25 million of cash and had to scramble to make payroll on Monday over the weekend, he didn't realize that he lent that $25 million to Silicon Valley Bank. That is legally how a bank deposit works. Your money is not yours. You're lending it to the bank. Now, it's even more acute when you lend it to the bank in a time deposit, where the bank can say, I won't give you your money back. You don't have a right to it. But most of us think when we put money in a bank, it's our money. It really is not. Unless you have a 100% reserve bank that cannot lend. And Again, the polarity of what happened with the Fed telling Custodia that our business model was unsafe and unsound, while they're saying that all these other banks are safe and sound, and then these other banks implode without the Fed even knowing. And one of the most hilarious comments, one of the worst time comments ever by a regulator, was Thursday morning when the Fed Vice Chair for Supervision, Michael Barr, who, by the way, sits over all the bank regulators at the Fed, made a speech, an anti-crypto speech, and he said, Fed-regulated banks don't have bank runs because they're subject to prudential supervision. I'm paraphrasing. But long story short, the guy in charge, the guy supposed to be minding the store, the guy who, by the way, his group, his division labeled Custodia's business model unsafe and unsound, he said that just as Silicon Valley's bank run was taking place. And by the way, he has been appointed by Jay Powell to lead the investigation into what went wrong at the Fed. Elizabeth Warren came out this morning and blasted the Fed for being the fox that's guarding the hen house, doing the investigation on their own. She got it almost right, though. She blasted Jay Powell and said, you need to recuse yourself. But she then said, oh, the vice chair for supervision, Barr, he should be independent and do his own work. And I just came over the top and said, he's conflicted as well. He's the one who made the statement that Fed supervised banks don't have bank runs, as the biggest bank run in 110 years was taking place. Okay, who's really minding the store? Mark Cuban asked that question over the weekend. Where were the regulators? And of course, the answer is what we were just talking about here. They intuitively think these leveraged fractional reserve, borrow short and lend long business models are safe. They need to re-examine their biases because they are not safe in this day and age where information moves that quickly, and banks have technology to be able to close your account from your phone in the span of the speed of light. The world has changed. Banks need to sit on a lot more cash. The Fed's going to have to expand its balance sheet substantially before this is all over.
Well, I'm going to ask you about the expansion of the balance sheet, but I do want to just raise something there with Elizabeth Warren, because you brought her up. She seems in conflict with Bernie Frank in that since Bernie joined a Signature Bank, he has, I don't want to say lobbied, but essentially he's lobbied for a loosening of the regulations that he was part of creating, similar to how Trump pushed for it. And we've seen Elizabeth Warren come out and blame Trump for an attempt to loosen these regulations, these Dodd-Frank regulations. Where do you sit within this? Because I think some people like the idea of tighter regulations and stress tests on the banks to prevent these kind of bank runs. But to see Bernie Frank to come out, I wonder if he's conflicted now he's on the payroll or was on the payroll Signature. It's a tricky one.
No, it is. But so here's the thing. I'm all for far tighter regulation on the banks. It's just not the regulation that they're talking about. The far tighter regulation is very simple. Banks should back 100% of their demand deposits with good old-fashioned cash. That way, if everybody lines up, all those demand depositors want to get their money out immediately, they can have it. That would make the system far, far, far more stable. That's not the regulation they're talking about, but I'm absolutely for that regulation. Hell, I helped. That's what Custodia Bank is, right? I mean, it's like an acknowledgement that money is moving faster, period, and banks are going to have to sit on a lot more liquidity. What's that going to do? It's going to make the cost of providing banking services go up for everybody. People hate paying fees. Now we're back to what we were talking about earlier. But the banks have high capital requirements and high technology and people costs. They're going to have to cover those costs somehow. They're going to have to charge you higher fees. But the system's going to be far more stable. I'll bet you if you explain that to most people, they would make that choice as opposed to rolling the dice with their money.